Okay, everyone, let's get down to business here. So it's Joe Pochodyniak again with MacNicol and Associates Asset Management. Really happy to have you here. And we're going to be giving you a tax tips webinar today, but very importantly, and this is, disclaimer we talk a lot about, we are definitely not providing direct tax advice. So please, don't take a snapshot of this screen with your phone and say, I need to do this because Joe told me to do that. I'm not. I'm really wanting to do this presentation from the investment angle. So there's a lot of stuff here that focuses on really what our clients kind of would need to know for their own, taxes in terms of dealing with us as asset managers. But there is a wide range of tax topics that we won't even, come close to touching here today, just because it is such a broad and in-depth topic area. So please do remember that. We'll give you a quick overview of the firm. Hopefully, you know a little bit about us by now. If not, I'll just cover that off and then quickly breeze through some of the Canadian and U.S. tax forms that you're likely to get from your interactions with us. One thing I want to do is I do, as many of you know, manage the Alternative Asset Trust, which is our main alternative asset vehicle here at the company now in its 13th year. And that particular vehicle has its own sort of tax process. And I think it's good as investors or potential investors for you guys to know a little bit about that. So I'll talk about that. There is a new program or programs for Canadians. We'll talk about the main one that I caught. Again, there's a lot of taxes out there, and there's quite a lot of stuff that I do not know. And a lot of this stuff is changing. And then we have some really good hints, tips, and suggestions. So let's get going. That's me. Definitely don't look like that anymore, but for what it is, if you've met me, great to welcome you to this webinar again. And do come check us out at MacNicol.asset.com/events. We always update that particular part of our website to keep you informed of what it is that we're up to. David got us started back in 2001, and I'm sure he would say it's gone by fairly quickly, even though we're in our second year of helping investors with their private investment needs. Of course, a selection of the accounts that we manage is featured up top, including some of the more specialized account architectures that investors will have in terms of pensions and foundations. We remain to this day 100% independently owned. We don't have any sort of corporate parent or that sort of thing, and we're very strongly supported by our custodial partners. Raymond James Canada is one of them, but there's others, and we really are a tightly knit team. But really, I think we're dedicated. We love what we do. It's hard work. For some of us, this is 10, 11, 12 hours a day of work. It doesn't seem like that all the time, because we know the end goal is really important for the people that we help. So let's get into these various tax receipts. You're going to be receiving a lot of these now. You probably already have. In my own situation, I think I got most of my forms done, but there's a few common forms. Again, from an investment perspective, that you're likely to see. This is not, T4s and all that kind of stuff. That's sort of a different, that could be a whole separate 1 hour webinar. But on the investing side, some of the more common forms that you're going to see coming your way are forms like this here. So this is the T5008, which reports the dollar amount paid to you or credited to you for securities that you basically bought and sold, or that your manager, i.e. us, bought and sold during the year. Very important you source this document and maintain it in a readily accessible location. Obviously, we can help support you if you're missing something, but really this is the official sort of de facto CRA form that you need to have. Reports, again, we have the ability to help you with that in some way. But remember, Canada Revenue Agency really is the authority for taxes in this country. You do need to keep track of your own tax forms. The next one that we point out here is the T5. I think T5s are probably a little bit more common, and it's really used to report the various types of income that residents of Canada have to report on their income tax or benefit returns. And importantly, investment income paid to non-residents of Canada is not really reported here. So that's something you always want to be mindful of, what your status is. If you're 100% Canadian citizen, you're here all the time, you don't have a US green card or anything like that, you really don't need to worry about sort of this non-resident stuff. On the other hand, if you're going, if you're a snowbird and you're kind of at that 180-day plus mark, or you've got a green card or other sort of factors, you do want to take that into consideration because you're more of a high flyer in that case. This is the three, and we'll talk a little bit more about this particular form, or sort of more how it's generated from the perspective of the alternative asset trust. So again, our alternative asset vehicle, because it actually puts out one of these. And so if you're a unit holder of the trust, definitely keep an eye on this. But really the idea behind the T3, which is called the Statement of Trust Income Allocations and Designations, it's used to report, again, the various types of returns that you would get from a trust. And it would be in particular those obviously forms of investment income that are not captured on a T5. So you're trading in securities. This is more the unitized entities of a trust or that sort of structure. One form that, I think to many, not all, but many of the listeners or attendees of today's webinar that might not be as familiar is the K1. And it's an IRS form known as Schedule K1. And it's really a form issued on an annual basis to entities and individuals in U.S. business partnerships. So I, in my role with the trust, get a ton of these, like literally a ton. If I piled them up after the end of each year, it would be probably a 3-inch high pile. There's just so many of them. And really the purpose of the K1 is to report on each individual partner's share of the overall partnership. So the earnings, the losses, deductions, and credits. And there is a parallel form north of the fine called a T5013, which I think we'll talk about in a second, but it's essentially the schedule of partnership income that you would have if you were involved in a Canadian limited partnership entity. And just at a very sort of glossing over broad brush stroke, non-tax advice level, really the thing with partnerships as opposed to corporations and other entities is really the partnerships kind of flow up their various earnings, losses, deductions, all that kind of stuff gets flowed up to the end entity limited partner. It's not the partnership that pays this. With a corporation, right, the corporation actually pays the taxes. So it's a little bit different. And if you're not familiar with LPs and how all that works, probably not a bad idea to speak with your advisor, whoever does your taxes on that. So let's take a look at the alternative asset trust really quickly from a tax reporting process perspective. So we're not going to get into what great real estate deal we bought this time in Georgia, or how many gazillions of acres that we bought in South Texas. This is just more of a process map, I would say, of the taxation of kind of this trust and what I have to do to get the T3 to the finish line. So there's a lot of forms and arrows and curvy arrows, and there's a guy down at the bottom. What does this all mean? Okay, so if you just focus your eyes on the blue box that says MacNicol Alternative Asset Trust, so that is an unincorporated open-ended trust structure. So when you come into the firm and you meet with us, you know that we certainly support the inclusion of alternatives as part of a overall holistic portfolio management process or solution here at the firm. That's fine. What happens next is you invest your monies with us. We go ahead and do our thing. And in a little while later, you start to notice that you own units of the alternative asset trust. So there's a line item on your statement. It shows the number of units of this entity here that you have, along with the valuation or what's called the net asset value. And it sort of stops from that point for you, the investor. For me and for us, there's actually simultaneously hundreds, and I would say thousands, but let's not get carried away, hundreds of individual things that are happening. Now, up here at the top left, you can see the thing that I'm hopefully circling with my cursor. If you can see it, this is a Canada Revenue Agency form called a Partnership Financial Return. So this is what I call the T5013. So this is the Canadian LP financial return. And of course, we are partners in a lot of US partnerships in this program, but a lot of Canadian ones as well. And so each year, as the year goes by, okay, I receive these from our Canadian limited partners, as I'm supposed to, because they are supposed to let me know about that. Similarly, our friends down in the United States, of which, quite frankly, in this program, there's more, we get these K1 schedules, okay? And it's very, very important that I get these. And at a certain point, if I haven't heard from somebody down in the States, I actually completely bypass emails and start calling CFOs and CIOs and saying, I need this, and I'm asking you to get this to me. And by the way, I'm not exactly asking. So that's now. These forms then funnel through into a tax reporting process that we have for the trust at our fund accounting firm, right? Because again, there's hundreds of documents, hundreds of pages, and again, it's not all me doing these returns and factoring them in. I'm very well supported by that. Remember earlier I showed you that slide that said, we're an independent asset manager, but we're extremely well supported. That's what I mean by that. So I have a ton of support in terms of making sure that we provide you and your family with accurate numbers. Now, once all of these things have been reported at this mid layer, okay, this is the LP layer. I call it the meat of the alternative sandwich. All of those T5013s and K1s and various partnership reports come up top into this structure. Okay, so my cursor is going up and to the left. Once the trust files its own T3, then you go down to this down arrow. Okay, and that is where this box, the T3, the statement of trust income allocations and designations, gets mailed to individual clients. Now, this is not one of our actual clients. This is just an actor looking at a financial report in front of his iMac screen there. But that is the process. Okay, so when you're sitting at home, or when you're booking a meeting to do your taxes with your advisor or accountant or whomever, while that's all happening and while you're kind of looking at the calendar, believe me, I am looking at the calendar even more. So I did want to walk you through that process. It's a bit clunky, and I'm really not the best person at doing slides, but this is how it actually works. So a couple of things. There is a new program for Canadians that we are just sort of starting to hear about. It's new, but the budget basically proposed to introduce a new type of registered, or what I call tax sheltered account. It's called the tax-free first home savings account. And I guess the government figured that houses were too expensive, and so they created this structure where you can save towards buying your first new home. And basically the way it works is contributions to this account, which they call the FHS, would be tax deductible, and qualifying withdrawals to purchase a first new home would be non-taxable. Now, there is a lifetime limit. As of today, I understand that limit to be $40,000. I was just on the CRA website the other day, so I believe that is accurate until they change it. And there's an annual $8,000 contribution limit to begin this year, i.e. 2023. Of course, any unused contribution room cannot be carried forward for this particular plan. And so it's really important, again, if you are, and I feel this is relevant to the parents on today's webinar, if you have kids that are, with someone, getting married, maybe looking to move out, on their own, that's great. You want to be kind of at least aware of this account, as it will help. In terms of eligibility, the individuals have to be Canadian residents, okay? And if you don't know what Canadian resident is, there is a very precise definition of it available online. So do ensure that you're aware of that. You have to be at least 18 years of age, and you must not have lived in a home that they owned. In other words, the individual who's going to be the first time homeowner, he or she cannot have previously. So this would not apply to myself or anyone I know, but you have to make sure that this is not, your second or third property in which you are the owner. For flexibility with respect to funds and other registered plans, there would be the ability to transfer funds from an RRSP, or a registered retirement savings plan, to this FHSA on a tax-free basis. So it's a rollover, and it should not impact your taxes. But you know what? If you're unsure, just double check with your accountant. And again, it's subject to the same annual as well as lifetime limits. And if amounts contributed to the first time home account are not used to purchase a first house because they're still too expensive and you just didn't find one that you liked, or whatever reason, these funds can then be transferred back to the RSP or a RIF on a tax-free basis. But the amounts transferred to the RSP or RIF obviously would be taxable on withdrawal, and that's just the way it's always been, right? So if you take money out of an RSP, there's withholding taxes at the source, and there's a T4 RSP that you have to take into consideration. And then similarly with RIFs, the way those work is there's no real implications for the RIF minimum. That kind of is mandated. But if you take out more than the minimum, then you're getting into issues with added T4 RIFs and withholdings. Be aware of that and make sure you don't accidentally do something you don't want to do. So just a few more things here. The existing home buyers plan. So this was the old, I understood this to be the RSP first time home buyers plan. So the way that worked is this plan was basically where you could tap into your RSP. So if you had an RSP, which I think pretty much anyone with earned income should, but that's another matter. You could withdraw up to 35,000 from the RSP without any sort of tax hit, as long as you used it to buy a residence, and you would have to pay that back over a period of up to 15 years, and your notice of assessment would show all that. Very importantly, it's important just to sort of highlight that again, an individual cannot make both the first time home savings account withdrawal and a RSP home buyers withdrawal in the same. So you can't, what they're essentially saying is that you can't kind of double dip or get around it is really what they're getting at here. Now we're moving pretty quickly, but I want to maybe at this point just sort of slow it down for tips, hints, and suggestions. And before I do that, I just want to, there have been a few questions emailed in, which I can get to, but we actually just had the opportunity to speak with someone before this call regarding, what let's say I get a K1 or some sort of U.S. tax form that I'm not really aware of. What should I do in those cases? So basically, there's three types of situations in which you'd have to file a U.S. return, right? If you're a U.S. citizen, that's sort of just common sense, I hope. If you're a green card holder or a non-resident alien, and that advice actually came in through one of the accountants that we deal with here at MacNicol for the alternative program. He's very, very good. So I certainly appreciate that. So let's get into some hints and suggestions. So this is what I've done here is I've just sort of chopped up essentially a personal T1. So we're not talking about corporates today. We're not talking about business. We're just talking about individuals. And the thing that I think you have to be aware of is you kind of have to have a general sense. You don't need to know it to the exact, decimal place, but try to have a good understanding of what your income even is, specifically your total income. So let's kind of go through these things. Obviously, if you have a job, your earnings from the job, your employment earnings, naturally that's for most people the largest slice of your total income. There's also pension income if you get that. If you're splitting pension income, if you have kids and you're getting the child care benefit, that is part of the tax summary. Dividends, interest, and any sort of investment income that you have, that of course is part of your, that goes into your total income number. If you have rental properties, real estate, right? Rental income, the sale of the property, you got to report that. Capital gains. So if you sold something for more than your cost, you have made a gain on your capital. Self-employed income and any sort of workers' comp or other federal payments to you, that's all income, and I believe that even includes things like alimony payments. So if you're receiving those, you got to be aware that you are receiving them. Then you have to have a general sense of what deductions are available to you for the purposes of reducing that total income. So the way you want to think about it is, individuals are a lot like a business. Just think of an individual as one sort of human that is a business. You bring in money through the top, right? Your revenues, and then you got to find a strategy to reduce that, right? So you pay less taxes and you get a bigger, what you call, refund. Okay. This is where there's a wide range of applications of this. This is really not something that we would talk about here because everyone's situation is different. But for a lot of people, these are RSP contributions. Every year we talk about our RSP season, and it's sort of this mad dash to the finish line type of thing. And so that's why I think it's really important to work with whoever your advisor is, work with us, even get a calendar out or a spreadsheet out and just start putting aside a little bit of money. I know life's expensive, to these RSPs, because if you have earned income and you're in a high tax bracket, I have personally seen situations in which a good size RSP contribution, if you have the room, right? If you have the room, so there's limitations on how much you can put in. So in this case, I believe the contribution amount this year is or was 29.2, so 29,210, subject to a cap of 18% of your previous year's earned income. So those things really can help. A lot of these other credits or childcare expenses, you really want to keep track of your expenses. And I think that through the COVID period, I think where people got sort of those notices of audit was maybe being a little bit, let's call it loosey goosey with expense issues here. Our RSP deductions are a little bit easier to make and to enforce. Like, you either have the contribution slip from the custodian or you don't. But with these other things, again, keep tracks of those, because if you do get audited, two things, right? It's not really a fun process, but I can tell you, if you get audited and you pass the audit, if you pass the audit clean as a whistle, they will leave you alone for years. Okay. And I think some of you might view tax authorities kind of, they make you a little bit anxious. You don't need to feel that way. Okay. They are not looking to harass ordinary law-abiding Canadians. I can assure you of that. So these are how you get to your net income, and really you want that net income to come down. Then you get into, what is your federal and provincial tax situation? How does that all work? And the various tax credits that you may be eligible for, so that you kind of get to that finish line of, okay, how much am I getting back? Or if I owe, how much do I have to kind of plan myself for owing? And so this is where you get into these non-refundable credits, these personal amounts, the various premiums, charitable donations. That's important, both from a financial sort of tax perspective, but I also think sort of morally and philosophically. I mean, if you're doing well, I think it's really important if you have the means to help out, because a lot of people don't, and it's tough out there for a lot of people. So definitely help out if you can. But again, you really want to have a sense of what this total payable number is. So the bottom line of this particular slide, that total payable number is going to be really, really important. Again, we're trying to get to a situation where we're maximizing the refund, we're keeping track of all of our expenses, we have all of our paperwork, and we can confidently file these returns, and not be worried or stressing out about them. Be well organized. I know it sounds like common sense. Anybody that's been to my office in Toronto knows that I can pass audits, strikes, nabs, like handle tens of millions of dollars down to the final decimal place, but my actual office periodically doesn't look that organized. And so you might not believe this, but every so often I do spend about an hour just literally physically reorganizing my office. So old reports, stuff I don't need, stuff that wasn't saved to a drive, I shred because it's less stressful, and it just makes life a little bit easier. Create a physical file. So upstairs in my own actual house, I have the my account with CRA and all of the electronic stuff, but I actually have the paper stuff in a little filing cabinet. And I don't know how many of you know this, but my late dad was actually an auditor for the Canada Revenue Agency. So I grew up from a very young age taking taxes seriously, and so that's why it's kind of overkill. But at the same time, I never stress during tax season. Make tax reporting a year-round thing. This is, it's just like a diet or working out. It's not really going to help you unless you do it kind of consistently, regularly. You don't got to go out and go crazy, but just every month, maybe do a quick check-in with a spreadsheet or a file folder, as is shown in the picture here, and just make sure you're on top of it. Anything. It's a lot easier to discover you're missing something or you lost something when you've got several months to go before the filing deadline. You don't want to be rifling through paperwork stressed out the night before your return is due. The other thing too is work with a tax advisor. So if you have an advisor, a planner, someone that gives you advice on that, work with them. Their costs are well worth it. And for the record, I don't file my own return. I pay someone to do that. I enjoy paying a professional to do something for me. I think it's a good, stress-free process. I'm simply keeping track of my paperwork, but get somebody to help you out. Also, if you're not on CRA's My Account or the US IRS equivalent, if you have those sorts of citizenship or green card issues, or you're non-resident, sign up for these services. They're free. They're pretty easy. They're quite secure. So in the case of CRA's My Account, there's all sorts of code words, and they text your phone before they let you in. So it's secure. Your information's secure. And you can really kind of get a quick sense of where you're at. Your returns are on there, your notices of assessment on there, your reassessments there. And I think that really these tax authorities, they do a good job of at least trying to keep us informed. It's not perfect. They're not out to get anybody. It's important, right? If people weren't paying their taxes, weren't paying their fair share, the country would run out of money, which is sort of a different topic. So do sign up for that. Do keep track of your notice of assessment. This is one for the trust, the alternative asset trust. So as you can see, it has its own notice of assessment. We're no different. When we say we make these tax filings, we do. And I know this one's from the tax year ended 2016, which was when I took over the trust. You know what? We have a lot of tax work to do as well, and we want to do things mainly accurately and professionally, so that you guys can be confident in us, what we're reporting to you, and all that sort of good stuff. Tax advisors. There's a lot of tax advisors out there, financial planners, people from various parts of the insurance industry. They're all great. And I mean, if they can give you tax advice, that's fine. This is just a selection of the accounting designations in Canada, a sample of them. There are more, and you definitely don't need your CA or CPA to do tax returns. There's nothing in the law that says, you have to be a chartered accountant to file returns or to prepare returns. But you know what? Look, I mean, I think credentialing is important. Experience is definitely important. I mean, the reality is there's new people coming into the industry all the time. And, if the person that you're dealing with, if your return is the first tax return they've ever done in their life, I mean, people have to start somewhere, but that's certainly a situation where you just want to be on top of that individual, make sure they're aware of dates, of forms, and kind of give them some guidance and support. If you're dealing with, a CPA that's done, this is their 10,000th tax return, then probably you don't need to worry. Okay, so that was a quick kind of foray through the world of taxes as we see it. It's hardly an immersive deep dive into stuff like US corporate taxes or even Canadian corporates, the residential property flipping rule or anything like that. Ken, we do have some questions, and I'm going to start off with one of the most important questions that I get quite often. Let me actually go back up to the top to the first page, so we're not looking at a Q&A slide here. So just give me a second. I'll just put it back to the front page so that we can all sort of look, definitely not at me, but at our cover page here. So one of the questions we get is on a T3 for the trust, what is a notional distribution? So that is a good question. Why did we issue a T3 for an entity where the end unit investor didn't actually get like physical cash in their jeans, so to speak? And so let's talk about that. So number one, it's quite common, right? It's quite common because trust structures or funds that invest in units of other private equity funds or underlying investments, the fact of the matter is that when you invest in units of another fund, sometimes the tax factors are not available on December 31st, which is the year end for our trust. So you really want to hold off. In other words, our fund accountants want to hold off on the distribution calculation until such time as those tax factors or inputs are ready. Again, accuracy. If you are paying out cash distributions to investors as of the year end, right, 12/31, you cannot book these factors later without impacting the other investors that came into the fund by that time. So let's just think about it. There's a calendar year. We continue to attract new investors all the time. People like our process and they want to invest with us. And at some point, those investing dollars do find it into our trust. Again, without these underlying tax factors, we would essentially be flying blind. And so therefore, a notional, and I say that in quotes, notional distribution is done. With notional distributions, the trust or the fund is still required to distribute all of the net income and net capital gains to investors so that it doesn't have a tax liability. Because again, remember, if it didn't make that distribution, it would. But the distribution is automatically reinvested in additional units of the trust. And immediately following the reinvestment, the number of units will be adjusted, or what you call consolidated. So that's the whole issue of the T3. Ken, I'm gonna just ask. There was a few other questions. I'm gonna stop presenting here. Actually, I'm gonna just minimize the size. There were a few other questions. Some of them were quite technical, and so I'll just preface them by saying if it's way outside of the scope of this webinar, I will respectfully take a pass. And similarly, if I don't even have a clue of what the question is asking, I'll take a pass on that and certainly email those questions in. But Ken, over to you. We did have some questions. Let's get through them.
Yeah, okay. So we had one question that you'll definitely be able to answer. What type of investments belong in what type of account? And then it says, i.e., open account versus an RSP versus a TFSA from a tax point of view.
Okay, so mercifully an easy one. So okay, so the general kind of the general kind of theory on how you can become wealthy and stay wealthy in Canada is you can invest wisely. We certainly hope we help you with that, and you can pay less taxes. So those are two sort of very general points. At some point, those two ways of thinking about life up here in Canada intersect. And so the question is essentially, what investments should I have in a taxable account, and what investments should I have in a registered account? Generally speaking, and this is extremely high level, again, broad brushstrokes, you want to have the least tax efficient stuff, let's call it, in your tax sheltered account, right? So stuff like a bond, something that pays you interest income, a debenture, that sort of thing. Similarly, the securities that, you get dividends from, particularly Canadian eligible dividends, stocks that you've got capital gains and losses in, those of course you'd want, to the extent possible, in a taxable account. And remember, we do periodically take a look at tax loss selling for our clients, right? It's there. Why wouldn't you? And the issue you have to remember is that you cannot, do tax loss selling in a registered account of any kind. TIFSA, RSP, you cannot. And so in that case, it becomes more of a pure, brute force investment sort of discussion. With a taxable account, if you paid capital gains last year, you can take, it's if you paid capital gains in the 2021 tax year, right now we're into preparing our 2022 tax returns. If you had losses last year, right, so you bought a stock, it got creamed, and you sold it and you stayed out of it for 30 days, which is the requirement, you can bank those losses and apply them against the gains that you would have paid in the previous year. And you can carry that back 3 years. You can also carry forward losses indefinitely. And so that would be what you call a reassessment. So the CRA would see that and they would reassess your 21 return, and hopefully you'd get some money back from that. So that's sort of a general sense. It's there's more to it than that. And I certainly appreciate the question, but I think it's again more important when you think about RSPs, taxable accounts, and tax-free savings accounts. In my mind, the application of these things, the beauty in these things is knowing how to apply them for each individual client, as opposed to maybe getting caught up in the weeds a little bit over what kind of an investment am I holding in each account. That's not to say that's not important too. It's just that I think that a lot of, the investors that we help and that we work for, they're working with an advisor or a manager that's structuring these accounts for them. So just go with that. Okay, next question, Ken, if you would.
Yeah, there's another question. It's kind of a statement. I kind of think I know where it's going, but it says RIF distribution rules at age 90 and beyond.
Okay, so RIFs and LIFs. So let's kind of just start before we know where we're going to at age 90. Let's worry about what all of these things mean before age 71. So a lot of these accounts are kind of all over the place, and they're basically all the same. They're registered accounts. It's just that an RRSP is one you fund yourself, whereas the locked-in plans or the LIRAs or that sort of thing, those originate from pensions. And so if you have one of those, great. The rules are ostensibly the same. There is some nuance here. Your advisors or other resources can help you, but essentially the calendar year in which you turn 71, you have to essentially wind these things down. Okay, you don't have to convert it to a RIF or a LIF or that sort of thing. You just have to determine what you're going to do with the registered plans. The overwhelmingly most popular option is for the last, I don't know, 15 years has been to convert it into a RIF, or if it's one of these old pensions, a LIF. And really the only difference is both of these plans, RIFs and LIFs, have prescribed minimum withdrawal rates. Okay, prescribed. So that just means the government tells you, or actually tells us and the custodian, how much the annuitant has to take out of the account. Okay, so you're told what it is that you have to do. That prescribed rate goes up. The only difference between RIFs and LIFs is that whereas RIFs only have a minimum withdrawal amount, okay, LIFs and those locked-in plans also have a maximum. Okay, remember what I said earlier is with RIFs, you can take out the minimum, or if you need to, you can take out a little bit more than that. There are tax factors to consider around doing so, but you can. With lifts and those sorts of things, it's much more challenging to breach that upper maximum withdrawal amount. There are situations in which you can do it. Obviously, if there's serious concerns about diminished life expectancy, which we certainly don't wish on anybody, you can get around that. Or if there's a financial crisis, you can get around that. The latter part of the question is what happens after age 90, and really the idea is they essentially want these things closed down. So that's sort of how that all works. And like I said on that, where is it here? This slide, the overview slide. We do handle a lot of these accounts, right? Pretty much all of our clients in some way have one of these accounts. You won't be the first. So we're very well versed in these account structures. Our custodians are all very competent in managing these sorts of accounts. You will feel comfortable. Next question, Ken. I think this next one might be a little bit tricky. I might have to kind of.
There's a few here that obviously we point you towards your accountant or tax professional to answer. But the next one would be basic strategies with investments in a corporation.
Basic strategies. So I, at this point would say the basic strategies of a corporation, that first word basic, I'm really grateful for, because just like any investment strategy, you I think want to be very, very conservative and very cautious. I hope everyone will support me on this. I think we've done a very, very good job of that. Overall, we were up in the trust 4.4% last year. A lot of our more equity public market accounts, they did very, very nicely relative to what happened in 2022. The more detailed aspect of the question with corporations is really talk to your advisor or your CA or whoever kind of helps you with that. Corporations are taxed differently, and in particular, the exemptions and the various sort of on and off switches, if you will, is quite different for corps, Ken. So we'll, with all due respect, defer that on to someone with a much stronger understanding of corporate taxes. And next question, please.
Okay, cool. The next one is, should I change my investment vehicle as I get older? I'm assuming that references asset mix, which is
me too.
A tax question.
Yeah, I would agree with you, Ken. I think the term there, vehicle to me means a completely different thing than to someone else, only because in the trust we have different vehicles, meaning we could have units of a limited partnership, right? We could have shares in an LLC, all sorts of different vehicles. So that's vehicles. I would agree. I think Ken, you nailed it. This is a question about asset mix, and the question is, should I change it as I get older? I have come to believe as I've gotten older, and I happen to have been getting older during a period of pretty much declining interest rates the entire time up until recently. I think the answer to that is I'm not sure. I think in general, there was this sort of view on the industry that as you get older, you take some of the money that you have in stocks, you take it out of the stocks and you put it into bonds for reasons that, I think are at this point kind of blatantly obvious, but let's tell everyone what the elephant in the room is, which is higher rates. That might not necessarily be the best strategy for you to do. And so I think really the asset mix becomes not a discussion away from asset mix, but what is the composition of the asset? So, for example, if you have stocks that you had when you were 35, you should probably have different kinds of stocks when you're 65, right? When you're 35, you want growth stocks because you've got hopefully your entire career ahead of you. You need growth. You may not have much. You're young. You're working, but you need to start building. When you're older, you really want that income, right? And you really want the stability that comes with income. A lot of blue chip dividend paying companies, the reason why they're able to pay a dividend is because they're more stable. They have more well developed, robust businesses. They have millions of clients, maybe as opposed to just a couple of thousand or a few hundred, and they can pay that dividend. And so I think the composition of your holdings is very, very important. And I'm not throwing bonds under the bus either. I mean, I think there probably is a place for them somewhere in the portfolio. That place really is a function of your risk tolerance and your needs. So yeah, I think this was more of an asset mix question, but it's also my feeling that and this is after 20 years is don't get too caught up in the asset mix. I mean, be aware of what your asset mix is. You obviously don't want to be someone like, for example, my mom, right? My mom's turning 75 in May. You know, hopefully her guy doesn't have her in 100% small cap tech stocks. Otherwise, we should take a stick and hit him over the head. So that's sort of the way you look at it. That because we're an asset manager, we're kind of constantly and chronically looking at economic and financial market data. So we're a great resource to talk to if you're working with an advisor kind of on the overall asset mix picture. That is good. But we can really, really help you by pointing you to sort of the finer points of the asset mix spectrum that you need to be aware of. A few more, Ken. Let's get through it, and then we can wrap this up.
Yeah, okay. So, next question, is it better to set up separate trusts for each adult child or one family trust for them all? Which,
Yeah, so this is way outside of my sort of knowledge base. And I almost feel that this is sort of like an Ian Hall type level question. But I mean, listen, we do have some experience with this, just not me personally. I think that this is not even almost a tax question as much as this is sort of a legal sort of risk management question. And I think where you should go the separate route, meaning two individual trusts, is where there is a very clear need to set up two individual trust structures per child. So maybe, one child is really, precise and responsible with money, or has a very stable personal or corporate life, whereas the other one does not. That is a situation where potentially you want to have a discussion about breaking up the trust. The family trust structure, I'm unfortunately not going to be able to touch here, Ken. And thank you to the attendee who submitted the question, but really I only know enough about that to be dangerous. I know family trusts is on this screen here in front of you. We really know how to manage the investments for a family trust. That we could help you with quite a bit. But answering the question of which trust structure is better for you, there's a whole barrage of consequences that could come out of that question that you'd really want to ensure you get the right kind of advice for. And again, we can point you to people that can help. It just wouldn't be me. So Ken, I think there might be one or two more questions we have time for. If
yeah,
not, Yeah, let's have it.
There's one in the chat here. When the payment for the home buyers plan started, I'm assuming when the question kind of references your repayment period, and I think that's the second year after the year you first withdrew those funds from
Yes.
an
Yeah.
RSP. So
That's right. Yeah. So let's use today as an example. So today is Thursday, March 23rd. Let's say a couple of months ago, you worked with a realtor, you found a house that you like, you put in an offer was accepted. Let's say the house closes on the end of March, so the end of the quarter. Ken is right. Once that money comes out of your RSP as part of the, again, first time home buyers plan. This does not apply if this is your fifth or sixth house. You do have essentially what I believe to be a sort of 2-year period before the clock starts in which you have to repay that. Now, how do you track the repayment of that? The same way you track everything with your notice of assessment. And so what happens is your notice of assessment will show that you have a balance in this home buyer's plan balance that must periodically be repaid back. And there's a calculation that determines how much each year you have to repay. And so when you replenish your RSP, it's important to make the distinction between our RSP contributions for the home buyer's plan and not. I think every financial institution might be a little bit different on this. I don't know the exact nuance of the custody side. I think that in some cases, the first dollar that goes in goes automatically towards repaying the home buyer's plan. And then after you cross that year one, like whatever the minimum amount is that you have to replenish, then you can start getting into, okay, well, the surplus can count as an income tax deduction for me. But just double check that with your financial institution, because that's something that must be done with some precision. Otherwise, you could be confusing two separate notice of assessment accounts.
that looks to be it, Joe.
Okay, great. So I'll stop sweating then. No, I appreciate doing this sort of tax tips webinar. I want to thank everybody for participating. It was for being an attendee. A really great turnout we're having on these, and I'm definitely not the the strongest tax person on the planet. But we like doing this. We love having you on board, and we certainly like investing with sort of an awareness towards tax. We definitely are aware of taxes. We wouldn't get into, again, direct tax advice, but we really appreciate the opportunity to have you here. Again, MacNicolAsset.com/events is your source for everything that we've got going on and coming up. A couple of really, really good pieces in terms of the weekly beacon, which Ken writes. For sure, encourage you to check those out, as well as some other stuff that we're working on. And for Ken and I, thanks so much. All the best to each of you, and we'll report back to you at the end of the quarter. Thank you.